for those of you who don't know me or our company, Unbridled Wealth, we basically have a family of companies. So we have 33 businesses, headquartered here in Denver, Colorado, but I have offices in San Diego, Denver, St. Louis, Grand Rapids, and Boston. And really function more like a kind of a small family office. And I think the blue collar business space has become increasingly more interesting to us in the last 5 or 6 years. So we started really as a live event company. So we do, the planning, logistics, travel, transportation, all of that kind of stuff in the live event space. And when I joined the company just over 10 years ago, we were doing, I want to say about 10 or $12 million in revenue. And in the last 10 years across brands, we've grown to, I think we'll do north of $200 million this year in revenue, and have about something like 400 employees. And it's been a really fun journey. And I would say a big part of it has been a business model that we've used that's been really twofold. One is, if you're not familiar with a Keiretsu model, it's a Japanese form of doing business that talks about having shared services or overlapping even ownership in companies and using each other. And that's been a big part of our model. Is we've looked at adjacent opportunities to us, and I know a lot of the guys presenting the last 2 days have talked about this, but is there other businesses you can acquire to roll up into your business to grow it quicker? Is there other adjacent businesses? If you start in gutters, is there house painting? Is there adjacent opportunities and businesses that you can easily move into? And that really was our model. So we had 3 companies in 2014, and we've got 33 today. But another part of it has been this strategy that I was going to present on today. We call it blue collar banking method. Very similar concept if you've heard of infinite banking or IBC, becoming your own banker. There's a lot of different phrases out there to talk about the same kind of strategy. For us, we used it predominantly as a way to store capital in our businesses to do three main things. We're using it to expand. So we use it to buy real estate. We use it to fund startups. When AI is behind, we use it to float the company. So it essentially becomes this capital pool that can be used for at any time for any reason. It also covers key man insurance. So we have all of our key people insured, that if something were to happen to them, their families are taken care of, as well as the business. And then finally, for our buy-sell agreements, which I would say one of the most common things I see out there, and Kevin and Chris, you've done a really good job with this, is people that have businesses and they have business partners, but there's no kind of coverage or insurance. And most people don't even know what their operating agreement says would happen if somebody was to pass away. And Kevin, you and I were talking about this the other day, because we both have those horror stories of, one partner tragically passes away, and the other partner, it may be written in your operating agreement that you have to buy out their beneficiary, their spouse, or suddenly, Kevin and Chris are in business, and you've got a third business partner, they pass away, and they're now in business with that person's wife or spouse. That's a big deal. So for us, we're helping business owners use life insurance as this asset to protect all of those 3 things. Does that make sense? Kevin, I don't know if you wanted to share anything on your experience with that, as I know you've already kind of walked through this process.
You set Chris and I up in this company, Blue Collar Millionaire, in our windshield company with our partners, with my roofing company. Yeah, for me, I'm sure a lot of people, there's nothing worse than if you lose your partner, you lose your friend. Now you got this business. Now their spouse and he's got 2 children, are asking, hey, isn't the business worth like $2 million and I own 50%? So are you going to pay me $1 million? Or now this person's in your business. I mean, now you got nightmares on top of nightmares. How are you going to pay for that? This puts that to rest. It takes that person out. It gives them the cash is what they want. They're not, you wanted to be in business with the person who unfortunately died, not their spouse who doesn't. This is just a key. It's nice and clean. Everybody wins, and it costs so little money for the value of it. So that's why I've done it on every single company. It's a no-brainer.
Yeah. Yeah, for us, we across our
Easy.
businesses, I think we've got like 50 life insurance policies across different partners, and that's where I like it being able to cover in several of those different aspects of the key man, the buy sell, as well as this kind of blue collar banking method. So Kevin, what do you think about? Do you want me to share my screen and kind of walk through just the concept of how it works? That'd be a good next
That'd
thing
be
to
a
do.
great way to go through. I'll let you do. If we have any questions, we'll ask. But yeah, if you could share your screen.
Okay, awesome. Well, hopefully my iPad will be showing up here momentarily. Let me know if you can see that. Okay, great. So I'm going to start by just assuming that you guys don't have any context history into how this works, and let you know we're talking about life insurance today, which I know is usually not the most fun topic to discuss. But I do think it is the single greatest asset for this strategy for a business or a business owner to own. So I'm going to specifically, without getting too far in the weeds, I just want to give you the kind of basics of how the concept works. There's a lot of factors that go into life insurance, right? There's different insurance carriers, there's different products, there's different designs of different products. And what I've found is most people have only been shown a certain design on a certain type of product. And I guess before I jump into it, I'm just going to go to a new screen here. The single greatest factor that affects your policy design is going to be commissions. And I think it's probably the part that's talked about the least when it comes to life insurance. So just to get it out of the way, if you work with a member of our team and we're working with you, we are an open book. We're happy to show you commission statements, how this works, talk to you in depth of what that looks like. But one thing I'll just start off by saying it's important for you to know is if you already own life insurance or you're buying a life insurance policy with somebody else, the way you design premiums, types of premiums, massively affects commissions, which massively affects your cash value or your access to cash. So there's two types of premium. There's what's called target premium, and then there's what's called excess premium. You don't necessarily need to know this other than to say the agent commission on target premium dollars is about 25 times higher than excess premiums. So what does that mean? It means the more of your premium being allocated towards target, the more, it means the higher your death benefit, but the less cash value you're going to have, the greater the expenses are. So what we're doing in our design is basically the lowest target premium possible, the highest excess premium possible. And the effect that has is you have much greater liquidity, lower expenses, more access to cash. So again, I won't harp on that point for too long, other than to say, I think it's important for you guys to know that if you're buying life insurance, if you work with somebody, that should be a part of the conversation. Okay, so I'm just going to give you a quick 10-minute overview of how these products work and why we use the strategy ourselves and why it could be appropriate for you to use in your business. So I'll specifically talk about an IUL product, which stands for Index Universal Life, and the different factors that are involved. So you obviously have premiums, which is money you're paying into the policy. You have cash value. Think of this as a line of credit. This is why it's called like a banking strategy or banking method, is you now have this revolving line of credit in the form of cash value. Then you have the death benefit, which is paid to the beneficiary when you pass away. So I use an example of somebody who's paying $100,000 a year in premium. I use 100,000 mostly because it's a really easy round number. But just so you know the scale of okay, how much do you need to have in cash to be able to start something like this? We have clients doing as little as $5,000 a year in premium. We have clients doing multiple $1 million a year in premium. So it can adjust to based on where you're at today. But for this example, let's assume you're doing 100,000 in premium. Rule number one, I'm going to tell you, or a good rule of thumb is whatever you do in year one, I want you to be able to do that at least 3 times. So if you did 100,000 in year one, think of it as a commitment that you're going to do at least 300,000 in premium within that first 5-year period. So there is a lot of flexibility in how and when, whether you do monthly, you do lump sums, there is flexibility there, but that's just a really good rule of thumb that if this policy is going to work for the desired purpose and strategy, you're going to need to pay in the premium at least 3 times. Okay, that's the first rule. Next thing, and how you do that is flexible, right? So you could do 100,000 year one, you could do 0 in year 2, and then catch up with 200,000 in year 3. So there is flexibility there. Okay, next, I just want to quickly talk about expenses. So how do expenses work on your life insurance policy? There's a few different types of expense. Again, we can run reports and show you what they look like. To make it simple, I'm just going to talk about it as a percentage of your cash value each year. So in year 1, your expenses, depending on your age, gender, health, expect it to be around 8 to 9%. Again, this is how we're designing it, not how it's typically designed. And that number as a percentage is going to decrease each year. So maybe year 2, it's somewhere in the 4 to 5% range, and maybe 2 to 3, 1 to 2. That's going to keep going down each year. It usually bottoms out about year 15, where your total expense by year is about 0.1%, 0.1 to 0.2. So very, very inexpensive. So again, we're looking at this as it's kind of like buying business, right? You're putting out money in that first year, looking for a greater return down the road. This is the same concept. The greatest cost, the greatest expense will be in that first year. It reduces down, and you'll have the best growth down the road. Okay, so that's how premiums and expenses work, at least a simplistic view of it. Next, I want to talk about, okay, so how do you actually make money? How does your cash value grow? So there's a few different options, again, depending on the product, the carrier, all of that good stuff. But you have different places or indexes you can allocate your cash value towards to earn money. So, there's always a fixed account. This usually will range in the, let's say right now with one carrier, it's 4.3%. So you could either just be earning a flat 4.3%. Again, it's tax-free growth, the way we're designing it. Beats your money market account earning 4% taxable. So we always have that as an option. But long term, we're typically allocating towards indexes like the S&P 500. The biggest difference here is, if you go and buy SPY in S&P 500 in your brokerage account, 2 years ago would have lost 20-ish%. 2008, it would have lost 40%. This year to date, it could be up 10%. The difference here is in your life insurance policy, there's a floor and ceiling model, meaning there's a 0% floor. So if a 2008 happens again, or I should say when a 2008 happens again, we're going to have recessions, we're going to have down market years. Your downside is protected with that 0% floor. And then there's some kind of a cap. So, the cap today with the same carrier is 9.25%. So you're going to earn somewhere in that range of 0 to 9.25% if you allocate towards that index. And then there's some other creative indexes too, like the Mark V, for example. It has a 0% floor, but it's uncapped. So there's years that it's performed really, really well. I had a client earn 14% last year, tax-free in his life insurance policy in the Mark V. So that's a very cool situation. Where you have some higher upside potential, but still the downside risk mitigated. So the way we're illustrating that is obviously a highly regulated industry. We have to use basically a 65-year average of this S&P 500 with the current floor and current cap. So we're illustrating right around 6%. I think it's 5.95% today. So when we are running an illustration for you, we have a good idea of a lot of factors like the premium and expenses, what you earn each year obviously it's going to change. It's not going to be exactly 5.95%. One year you might make 10, next year you might make 0. But for the best illustration long term, we just have to assume this average of 5.95% each year ongoing. Kevin, was that clear? Did that make sense?
Yes.
Okay, great.
Understand that.
So, okay, so we've got premium, we've got expenses, we earn credits, and that gives you your cash value. So it's pretty easy formula. Your cash value is your premiums minus your expenses plus your credits. So in that first year, if you have a 9% expense, 6% credit, you're going to have somewhere around 97,000 in cash value. Again, we'll focus more on this. That's going to be your line of credit. Then next year, let's say, we're going to have about 197,000. Maybe next year you're up to 303,000. Let's say you're paying for 5 years. So then you'll have about 410, then maybe 530. So your cash value does grow over time. And again, this is a pool of money that is liquid and available to you at any time for any reason, which again will hopefully make a lot more sense here shortly. Final aspect before I show you kind of why we use this is the death benefit. Again, this is the part that's probably overlooked the most of like, well, I mean, that's for way down the road. It's not really important. But as Kevin and I have both experienced, when you have business owners and business partners, this is a super valuable aspect. Or if you're married, you have kids, just having that protection. So I know that like I'm an owner of those 33. I'm an owner in 9 companies. My wife owns 3 businesses. We just bought this log cabin company in Colorado last year, which is taking a pretty significant amount of work, and there's 6 business partners in it. I know in all of these situations, if one of us dies, their family is taken care of. Their equity is bought out by the partners using cash from the life insurance policy, and the surviving partners now get to own 100% of the shares. So it just creates this kind of win-win. So the death benefit, it starts usually about 15 times the premium. So in this example, again, depending on age and health, but for this example, we'll say it's about 1.5 million. And we usually keep it flat for as long as possible, just to keep expenses low, but that number will grow over time. So got your premium, you've immediately got a death benefit. So we've got your buy-sell agreement covered. We have this cash value that can now be used for your family or for your business. So the real question that you should be asking at this point is, okay, it's good that you've got a death benefit, but you're losing access to money. If you're paying in $100,000, you could just buy term insurance and cover short term for less expense. And so I want to explain the reason why we do this. Okay, let's do a fresh page. I've actually got an illustration up behind me, so I'll use some real numbers. Which if I can get it up, and I can show you guys this later. But in year 5, in that example, you would have $531,933 in cash value. Okay, so let's just talk about hypothetical. You've been funding this 5 years. You decide you're done funding. You're not going to pay any more money into it, but you're just going to use this as your revolving line of credit for your businesses. And let's say there's a business for sale, and it's a landscaping company, and they do landscape architecture, design, full works, it's crushing it, and you need $500,000 to buy this business. Maybe you're financing the rest. And so you go to your policy and you take $500,000 as a loan. Again, these loans are not reported to bureaus. There's no repayment terms. It doesn't affect your ability to get SBA money or anything like that. It is just a transaction between you and the insurance carrier, where they will guarantee you between 95 and 99% of your cash value at any time for any reason. So let's say you take $500,000 out in a loan and you decide you're just going to pay interest only. The way these loans work is you're going to be charging interest as a true expense, goes to the insurance carrier. It's going to be range between 3 and 5 point. It's actually going to range between the 3% and I can go back here. This fixed account plus 1. So with this particular product carrier right now, it's a between 3 and 5.3% loan. It's historically been around 4.2% to give you like kind of long-term average, but let's assume it's staying at 5%. So much higher than the long-term average. So if you borrow $500,000 from your policy, that's going to be $25,000 a year in interest. Okay, so let's say you borrow the 500,000, you buy this landscaping business, you do interest only for 10 years, maybe you do an SBA loan for the rest of the business, and so that would be $250,000 total cost in interest that you're paying. There are situations where that interest can be tax deductible as well for certain qualified business and investment purposes. So potential cost savings there on the $250,000. But the real reason we're doing it is, even though you've taken a loan against your cash value, this is the part that a lot of people don't understand, the entire $531,000 keeps earning as if there's no loan currently against it. So at that same time, again, you took the $500,000 in cash, went and bought a business with it. You're making money in the business. Things are good. Maybe you exit after 10 years and repay your loan, but during that 10-year period, the $531,000 keeps earning based on your index allocation. So if let's assume the same thing. Let's assume a 5%. Actually, I'll do what the illustration actually gives me, which is the 5.95%, that 65-year average gross return. So in year 1, it's going to be around $30,000, something like that. And then year 2 is compounding, right? So year 2, you're earning on 561. So maybe it's like $31,000. So next year you're earning on 592. So that your cash value will continue to grow and compound every year because of that growth. So over that 10-year period, the same 10 years, actually wrote it out here, it grew 313,000. It grew from 531 to 845 tax-free. So you had $314,000 in growth. So I usually ask this question of, if you had a situation where you've got your $531,000 at Wells Fargo or Bank of America, and you walked in and said, hey, I need $500,000, I'm buying this business. And they said to you, hey, you've got 2 options. You can just withdraw it and go use your cash. So it's yours. Or your second option is, we're going to charge you interest of $250,000 over the next 10 years. But at the same time, we're going to credit you $314,000 tax-free. Plus, we're going to give you life insurance. Plus, we're going to give you creditor protection. Plus, we're going to have enough coverage for your buy-sell agreement. Which one of those deals would you take? And that's really the thing we like to look at is, can we have a situation where we cover the life insurance need? We have now this liquidity that you can use for your business when your 90+ day AR is much higher than you'd like it to be, and you need some extra cash to make payroll, or you're buying that piece of equipment at the end of the year to get the tax write-off. Do we have this capital that is available to us? And then even when we're using it, can we create this positive arbitrage? Meaning we're making more money over a long period of time than it's costing us, while still getting all of these fringe benefits along the way.
Jonathan, quick question. Back on the policies. Tyler asked, what happens to a policy when the business is exited by the policy covered partners and all the partners together? What happens to that policy?
Yeah, that's a really good question actually, because we have had that happen. We've bought out somebody who we had an insurance policy on. So you have a couple of options. You can either use the policy as part of their buyout if they're exiting. So it could be, hey, the cash value is $367,000. That's part of the purchase of their equity, so you can gift it to them. Ultimately, the business owns the insurance policy. So uh, we had a very minority partner in one of the business that we had an insurance policy on. We bought him out. He left. We could choose to just keep it and still use it as an asset of the business. So it's really up to the business owner.
And if you just exit the business for $5 million, you sell it to private equity, the policy then is just over because the company's over?
No, you can just change it to own it by another entity that you have or personal.
Okay.
So yeah, which is why
A lot of
we
options.
definitely, yeah, there's a lot of options. LLCs are the easiest because if the LLC owns it, you can transfer it to the owner of the LLC with no tax implications. So we do a mixture of things. It often does make sense if you're the only owner of a business, like you're sole proprietor. It usually makes more sense for you to own the policy personally, even if you're using it as a line of credit for the business, because then your credit is protected.
Can you talk about one thing on the floor? When the floor was zero, I mean, I know what it means. Can you explain that? Like people say, hey, you can go up to 95, but you can't go below zero.
Yeah, maybe the easiest way is, let me show you an actual illustration here. Okay, so this is the index options on one of the policies that we provide. So you can see here, this is the S&P 500 index yearly return from 2004 to 2023. So it's a 20-year history table. So you can see in 2004 it earned 8.99%. You would have been credited 8.99%. Skip forward a few years, 2008 hits, the negative 38.49. So if you had 100,000 in your brokerage in the S&P, you now have 61,500, whereas your credit is just zero. So the way it practically works is your insurance policy is essentially buying options in these indexes, and so if the index goes down that year, you just don't earn a credit, but you don't lose any money either. Does that make sense?
Makes sense. Yeah.
And while I'm here, let me just show you this one too, because this was one of the other examples I gave, which is the S&P Mark V. This one is a little bit different because the S&P is obviously capped. Here, and you can see the 1-year cap, the 2-year cap. This index is interesting in that it's uncapped. So if there's a negative year, you can see here, you're still credited zero. You didn't lose money. But you have a higher participation rate and it's uncapped, meaning, so what 204% participation rate means, if the index went up 5.94%, you'd be credited 12.12%. So you can see it varies how well it does. I often get asked, like, why would you not always be in this index? Which is understandable. The reason being is, like, you can see the last 3 years, it got a 0, a 1.25, a 5, a 4.7. It doesn't do great in high volatile years. Obviously, since COVID, it's kind of struggled.
Right.
Now, this last year actually did pretty well. I think it was, depending on where the year started and ended, it did about 7%, which gives you about a 14% return. But there are those years that you could get feasibly a 20, 29, 18% return on your policy, which is pretty amazing.
Well, quick question. Can a C Corp or S Corp set up an LLC under them to hold the policies?
That's a great question. And the answer is yeah. Yeah, life insurance LLCs is exactly a thing that you can do. You can like mirror ownership is often a way that you would do it, is the ownership of the other entity, do the exact same ownership structure and have that own the policy. Because yeah, a C Corp owning a life insurance policy, absolutely possible. Does happen a lot. All the Fortune 500s own them. But if you ever wanted to transfer it out of the C Corp, there could be tax ramifications.
Can you give I don't know if you're doing more in your presentation, do it. Otherwise, maybe give an example of how you used it to potentially buy a business, or I could do it with how I did it with through you for the windshield business.
Yeah, I'll start with our initial one, and then I think it'd be great if you shared your story, Kevin. So this is slide's actually a little bit outdated, but this is some of our companies that we own. So originally we had Unbridled Solution, this one here in the middle, and we knew that we were going to start this model of starting new businesses. We bought the Grant Street Mansion, historic mansion, used our own construction company to renovate it, and we played the tax credit game. So we got about 50% of our cost back in historic tax credits, and we've used that as a major strategy for building our real estate portfolio. So what we did early on, this was like 11 years ago, 10, 11 years ago, Unbridled Solutions bought a policy on the CEO, who's also the majority owner. And then we immediately turned around and used that to fund a new startup that was offering with Unbridled Media in St. Louis. It was a marketing agency. And we set them on basically a 5-year loan agreement for more than what it was costing us in our policy. I think we were charging 6% back then, because that was when interest rates were insanely low. So we were charging that business 6%. We took 51% ownership in it, because it was another guy that was doing everything running. We were basically just capitalizing it, and said he has 5 years to pay. We also told him, the moment you pay off the loan, we'll drop down to 19% minority ownership. So we did this as a way to protect the loan, make some interest, have some ownership in a new company. So he was highly motivated to get us paid off as soon as possible. So he wanted to get us the money back, which we wanted, so we could go use for the next business. And what happened was, about 6 months into that business, the revenue projections weren't what he had hoped they would be. And he had a cash issue. So we just said, hey, go interest only 6 months. No big deal to us, because we don't have any repayment terms. We're not the SBA, we're not a bank. So he dropped him down to interest only for 6 months, and he was able to catch up and get started on payments again. We did actually exit that business, so we have sold businesses, but he got us paid off, exited the business, and then used the cash and went and bought the Bosworth Mansion here, which is our second building. So that's how we've practically been using it.
Well, so I'll tell you the way I do it. I mean, it's super cool. Jonathan set it up. So, and I'm going to do this over and over. I was buying a windshield business with Chris and Mark Evans, who was on earlier. We were buying that business cash, and we had 2 operating partners in it. So I was sitting on some money. I went through Jonathan, got the whole life insurance policy. I dumped cash in there. Then was like 60 days later, I went in there, took money out of my own policy, borrowed from myself, bought that business, essentially paying the interest, the arbitrage on the interest, and then that I was paying, and the interest that I was getting is like 1%, 1.5%. So it's costing me like 1.5%. But we've more than 10x that business now. So I mean, the rate on return is insane. Plus, I get this huge death benefit. And now Jonathan knows I'm exiting, and I'm going to be dumping more money in there. I'm going to do it over and over again. I mean, I'm essentially my own bank with this big death benefit. And there's so many other things. I don't know if you talk, like, in most states, I'll let you kind of talk about that, but this money that's in that whole life insurance policy is exempt from creditors if you ever got sued or something happened.
Yeah, which is another one of those kind of fringe benefits we don't really talk about much, but it's not important until it's important, right? Like, you don't really think about it until a lawyer comes knocking. I have been involved in 4 lawsuits in the last 12 months. It's what I remember getting started in business and somebody telling me it's not a matter of if, but when you're going to be involved in a lawsuit. And I wasn't sure I really believed them. And now I believe them, because it does just happen. So if you personally own the policy, and you have, depending on where you live, it is state by state. But if you're in Florida or Texas or Georgia or Alabama, a lot of Arizona, a lot of those states, your cash value in your life insurance is 100% credit protected. So it's been a pretty great strategy, especially people in Florida that like, hey, your primary residence is protected and your life insurance cash value is protected. It means that lawyers are less likely to try and sue you because they don't see assets that they could actually go after. So lawyers and people who are suing, they're motivated by being able to actually win the suit and collect the cash. But the other thing is, if you are sued and there is a judgment against you, they don't get access to your cash value. So you can make it right, get through it, and then pull out that cash value and use it for living or getting a new business or whatever that thing is.
That's a huge thing. And what you just said is so true. I had the same thing. I had a cousin who was an attorney. He said, it's the when, not if you get
Not
sued.
if,
When I
yeah.
did get sued, he said, okay, congratulations. You're kind of successful now. It will not be your last. He was right. I got sued more. It's just what happens. We have to
Mhm.
protect those things. And this is a super smart way to do it. But I thought
Yeah.
it was just such a cool, it's kind of just a cool, clever way of buying a business. And essentially borrowing off yourself. And we're all people who want to invest in ourselves. We don't want to give people a lot of times money and say, hey, oh yeah, go try to make 10%, because we have ways to think how we can double it. And we have
Yeah.
success. That's why we're in this group. That's why we're doing it. So this is a great way to have the best of both worlds.
Yeah, I totally agree. And I think it's why our clientele is usually passive investors, blue collar business owners, entrepreneurs, is it's less likely it's going to be the people that are like, yeah, but if I put my money in the S&P 500 in my brokerage account, I'm going to have a better rate of return over a long period of time. It's like totally missing the point. We do this as that, storehouse for your capital to expand your business, to grow, while still having all of those benefits at the same time.
And then let's talk about age. I mean, you could do this at any age. You can do this on any level, really, right? I mean, I should have done it much earlier. We talked about you could do it for kids, and I see one guy in here, I know him, putting next level with the fire thing. He's a young guy and he's
Yeah.
looking to buy businesses. It's a great opportunity for him to set himself up early.
Yeah. Yeah, I mean, I think obviously the younger the better because it just has more time to compound. I give a lot of rules of thumb, so like rules that can be broken depending on the situation. But a good rule of thumb would be age 25 to 55 for getting started. And then if you're younger than that, it's obviously mostly going to be juvenile policies. So I bought policies on my kids. I'm doing it instead of a traditional 529 plan, which only pays for college payments. Because I doubt me and my wife are entrepreneurs. I doubt my kids are going to college unless they wanted to become a doctor or a lawyer or something. But I think it's more likely they're going to start businesses. So I did policies on my kids. 25 to 55 is the sweet spot. And then above the age of that, it just depends. You have to look at it as kind of a case by case example of what makes sense, just so we don't have too much expense in the policy.
Awesome. Jonathan, how do people connect with you if they want to talk to you about these strategies and setting themselves up and their family?
Nice. Oh, thanks, Jack. I just saw he put our website in the chat. Blue Collar Banking Method. You can actually go on and sign up for a call with one of our advisors. info@bluecollarbankingmethod.com is a good email to use. I would say my recommendation for you guys listening is if you have more questions, you want to talk through it, you want to see if it makes sense for you based on where you're at today, then just schedule a call with us. We don't charge for that. There's no fee to sit down. It's a free consultation. And to be totally honest, if we don't think it's a good fit for you, we'll tell you that. We don't have any interest in trying to sell something that doesn't make sense for somebody. So come ask questions. There's obviously a lot more depth to the strategies and the products and what we're able to cover today. But we're really good at assessing people's situations and making a recommendation of like, hey, if I was in your situation, this is what I'd do. Or even we were in that situation, this is what we did. We can show you what we've done in the past as well.
Jonathan, awesome stuff. Appreciate you for coming on. And I got to set up, I'm doing it right now, set up the appointment because we talked about with my son and stuff.
Absolutely. Okay,
He's
great.
already
Well,
got
yeah,
awesome.
get back on my calendar.
Thanks for
Let's do
coming
it.
on. And you guys, you can see him in Blue Collar Millionaire, but that's the link, bluecollarbankingmethod.com. I love the name.
It was inspired by someone.
Yeah.
All right. Well, thank you so much,
Thanks,
Kevin.
John.
Appreciate everybody's
All right.
time.